$1 trillion wiped from the crypto market in days. Not by a hack, not by a crash, but by tariffs? That's not the kind of headline you expect to see in a space obsessed with decentralization, halving cycles, and ETF approvals. But while everyone was watching for the next crypto catalyst, it emerged from somewhere else entirely: a global trade policy. A few targeted tariff announcements, strategic, sharp, and politically timed, rattled global markets. Crypto didn't crash immediately. It twitched, then spiraled, and then it bled.
Look how they massacred my boy.
But here's what most people don't realize. This wasn't just a reactionary panic, it was structural, predictable, and in some ways inevitable. Because tariffs don't just disrupt trade, they disrupt trust. And trust is the only thing keeping crypto afloat during volatility. So the real question isn't why it happened, it's what this tells us about where crypto is headed next, and how insulated it truly is from geopolitics. Welcome to the Swap Space channel. Today we're looking at the effects of tariffs on crypto. In 2025, trade policy shifted dramatically from diplomacy to economic warfare. The US president's new tariffs, imposing a 10% baseline on all imports and up to 145% duty specifically targeting Chinese goods, weren't just symbolic gestures. They were precision strikes aimed at global logistics and critical supply chains already battered by years of disruption. Markets immediately reflected this turmoil. Within hours of the announcement, major indices across the globe dipped sharply. The WTO issued a rare warning, forecasting that these tariffs could reverse global trade growth entirely, projecting a 0.2% contraction in the global goods trades over the year, the first negative outlook since the 2020 pandemic era.
Name: Corona. Surname: Virus.
To put this into perspective, a fraction of a percentage point might sound trivial, but in the interconnected web of global commerce, it represents billions of dollars, thousands of disrupted businesses, and millions of impacted livelihoods. In other words, it's massive, and crypto was bound to feel the aftershocks. Now, the crypto markets are hypersensitive indicators of global sentiment, and the tariff impact was crystal clear. Bitcoin's price fell rapidly from nearly $88,000 to just over $83,000, erasing gains built painstakingly over previous months. This drop wasn't just an isolated phenomenon, it dragged down major crypto-related stocks as well. Coinbase, for instance, shed over 6% of its market value, while MicroStrategy saw declines closer to 8%. Such reactions aren't random. They're clear signals of crypto's interconnectedness with broader financial market sentiment.
It's all connected.
Crypto doesn't exist in isolation, as some narratives suggest. When global liquidity tightens and when the appetite for risk shrinks, crypto inevitably feels the chill, often first and most acutely.
Crypto bro, okay?
The tariffs' direct impact on crypto's physical infrastructure, specifically mining operations, is profound. US-based crypto miners rely heavily on ASICs and GPUs imported primarily from China and Taiwan, equipment now significantly more expensive due to these tariffs. Margins, already razor-thin after previous halvings and rising energy costs, are rapidly approaching breaking points.
Scudworth, you're walking on thin ice, man.
Two clear scenarios are now emerging: consolidation and migration. Smaller operations that can't absorb cost increases are shutting down, liquidating, or being absorbed into larger players, and bigger mining companies are actively relocating to tariff-free regions, often politically neutral or economically aligned countries offering stable regulatory environments and affordable power sources like Kazakhstan, Iceland, or parts of Latin America.
From Kazakhstan.
The result isn't merely economic, it's structural. It reshapes the geography of crypto mining and potentially weakens the very decentralization that underpins cryptocurrency security.
That makes sense.
Investor psychology in response to tariff-induced volatility is changing fundamentally. Traditionally, investors rotated from equities to bonds or gold in uncertain times, but now some institutional investors are increasingly considering Bitcoin as a viable macro hedge despite its notorious volatility, precisely because of its decentralized anti-inflationary characteristics.
I'm gonna have to buy some Bitcoin.
Recent analysis highlights that as tariffs stoke fear of sustained inflation, reduced economic growth, and prolonged trade disruptions, Bitcoin's fundamentals, the scarcity, portability, and independence from sovereign manipulation, gain attractiveness. Rather than a speculative frenzy, we're witnessing a sober re-evaluation of Bitcoin's place in diversified investment portfolios as a long-term macroeconomic hedge. China's reaction to the tariffs was swift and strategic, immediately suspending Boeing aircraft deliveries and halting postal services to the US. China targeted symbolic and practical aspects of American industry, affecting major companies like Tesla, Apple, or General Motors, companies deeply embedded in intricate global supply chains. But the truly strategic move occurred more subtly is China's accelerated gold accumulation. Over recent months, China's central bank dramatically increased its gold reserves, pushing gold prices to an unprecedented $3,300 per ounce.
Gold! More gold!
Analysts interpret this as a strategic pivot away from the dollar-denominated assets, preparing for greater financial autonomy in anticipation of prolonged economic conflict with the US. This gold buildup isn't merely defensive, it signals China's intention to reshape global financial landscape, diversifying reserves away from traditional Western financial institutions and potentially positioning itself for greater leverage in future geopolitical negotiations. Now, beyond physical commodities, digital assets are becoming another front in geopolitical conflict. The US government's recent regulatory crackdowns on stablecoins, particularly those pegged to the dollar, are causing significant international tension. Italian Economy Minister Giancarlo Giorgetti explicitly warned that stablecoins might now represent a greater economic threat to Europe than tariffs themselves, underlining the critical issue of monetary sovereignty. The European Central Bank has reacted aggressively, accelerating development of the digital euro, and this move isn't about technological convenience, it's a strategic response to counter the dominance of dollar-backed stablecoins. For Europe, this is about preserving monetary sovereignty and ensuring its economic fate isn't entirely pegged to the US monetary policy decisions. In short, stablecoins, once seen as a simple digital cash equivalents, are now geopolitical instruments deeply tied to the ongoing battle over global monetary control.
Greed is right. Greed works.
Now, tariff-induced crises aren't new, and history offers sharp lessons. The Smoot-Hawley Tariff Act of 1930, designed to protect American industries, backfired disastrously. It triggered reciprocal tariffs that spiraled into trade wars, shrank global trade dramatically, and prolonged the Great Depression. While today's tariff strategies are more precise and targeted, the underlying risks remain the same. Increased protectionism fragments global markets and exacerbates supply chains disruptions, accelerates inflation, and intensifies economic nationalism, risks that crypto paradoxically both exacerbates and offers potential refuge from.
Bad things just keep happening over and over.
Unlike 1930, however, today's investors have digital assets as potential safe havens. But whether crypto fulfills this role or merely amplifies systemic instability is still uncertain.
Theoretically, it should work.
Now, the interplay between tariffs and cryptocurrencies isn't straightforward. Tariffs introduce friction and uncertainty into traditional markets, precisely the conditions crypto markets thrive on, albeit chaotically. In the short term, we'll see continued price volatility, regulatory uncertainty, and market confusion. But long term, these conditions could foster accelerated adoption of decentralized finance and blockchain-based solutions, representing investors, businesses, and even governments with compelling alternatives to traditional financial systems. Crypto's potential to reduce friction, bypass political bottlenecks, and decentralized economic power could position it as critical financial infrastructure rather than speculative assets. Yet the path forward isn't straightforward. That kind of rhymed.
Rhymes with Arnold Schwarzenegger.
Regulatory frameworks remain uncertain, geopolitical tensions persist, and technological innovation is unpredictable. Investors and policymakers face an intricate balancing act, safeguarding economies without stifling financial innovation and adapting to rapid change without compromising economic stability.
That must be terribly difficult.
Meanwhile, emerging markets have begun to reveal their unique relationship with crypto amid tariff tensions. Countries like Brazil, Argentina, Turkey, and Nigeria, which historically experienced currency instability and economic turbulence, are seeing significant upticks in crypto adoption. Tariffs indirectly accelerate this trend by weakening global trade confidence and fueling local currency volatility, pushing citizens towards alternative stores of value and decentralized financial solutions. Recent data highlights that in Argentina, Bitcoin usage surged by nearly 30% in the weeks immediately following US tariff announcements. In Turkey, crypto exchange registrations spiked by almost 50% as citizens sought financial shelter amid fears of worsening inflation and further economic isolation resulting from global trade conflicts. In these regions, crypto isn't speculative, it's actually practical. It's not just investment, it's economic survival.
If it wasn't for you and me, this planet would be in flames.
Adding complexity to this narrative, central banks globally are accelerating the rollout of central bank digital currencies. China already leads this charge with its digital yuan, widely considered an attempt to reduce reliance on dollar-dominated payment systems, particularly in response to rising tariff pressures.
Why are you learning Chinese?
The US Federal Reserve is also actively piloting a digital dollar, aiming to maintain its global monetary influence and an increasingly fragmented international economic environment.
That's the Democrats for you.
Europe's digital euro similarly seeks to fortify the EU's financial sovereignty against dollar-backed stablecoins and potential trade-related disruptions.
Bratislava.
$1.83 American. What are we gonna get with that?
CBDCs represent a paradox for crypto, validating digital money's legitimacy while simultaneously posing risks to crypto's decentralized ethos, and how crypto markets adapt to CBDC proliferation could define their long-term relevance and sustainability. Environmental, social, and governance concerns are intensifying precisely because of tariffs and trade conflicts.
Everything's connected, everything's vulnerable.
The global trade slowdown prompted by tariffs has driven companies and investors to scrutinize supply chains and environmental practices more closely. Crypto mining, criticized for high energy consumption, faces renewed scrutiny under these tightened ESG frameworks. Mining operations in some regions reliant on coal-fired energy face severe criticism and regulatory pushback, accelerating a shift towards renewable energy sources for crypto miners. Aligning with ESG principles isn't just ethically sound, it's becoming economically necessary, especially as institutional investors demand clearer ESG compliance. Now, the tariff-driven economic disruptions are inadvertently compelling crypto miners to adopt sustainable practices sooner rather than later, a silver lining to otherwise restrictive economic conditions.
Can't talk, saving the planet.
Decentralized platforms, often promoted as immune to traditional market forces, are now facing their first true global economic stress test. DeFi's growth exploded in low interest rate environments. Now, with tariffs stoking inflation and volatility, DeFi yields previously attractive to investors are now under severe pressure.
Got a dream. What is your dream? To have a dream.
Recent market analyses show liquidity pools shrinking and lending protocols experiencing increased volatility.
What's the alternative?
Yet, DeFi still holds promise, particularly in offering alternatives to traditional banking systems hampered by geopolitical friction. DeFi's survival and growth under current conditions could validate its foundational promise of financial decentralization. Now, while tariffs triggered the latest crisis, broader macroeconomic uncertainties remain the real driving force behind crypto's long-term potential. Growing global debt, inflationary monetary policies, geopolitical instability, and trade conflicts collectively highlight traditional financial systems' vulnerabilities.
Yeah, everything sucks.
Now, crypto, Bitcoin specifically, has often been proposed as a neutral monetary alternative insulated from state manipulation. Increasingly, institutional voices are aligning with this thesis, recognizing crypto as an alternative monetary regime rather than just speculative assets. And the longer geopolitical friction and economic uncertainty persists, the stronger the case becomes for crypto's broader adoption, not as a niche speculative technology, but as a mainstream monetary alternative. Crypto stands at a crossroads: evolve into a resilient macroeconomic asset or remain volatile, vulnerable, and dependent on geopolitical events.
Diplomacy is option 1, military is option 2.
As traditional systems fracture, crypto's adaptability could position it as critical infrastructure, but adaptability means confronting uncomfortable realities, embracing regulation without surrendering decentralization, adopting sustainable practices without sacrificing security, and engaging global policymakers without compromising autonomy. Crypto's survival in this reshaped economic landscape depends on navigating complex dynamics of trade policies, ESG considerations, regulatory pressure, and emerging market demands.
So that's definitely difficult.
In a world rapidly reshaped by tariffs, trade wars, regulatory pressures, and financial instability, adaptability isn't just advisable, it's more mandatory. Crypto's place within this new world order is being decided now. Investors, regulators, miners, and users alike must prepare for continuous, unpredictable change. The stakes are clear, however, and the outcome remains uncertain. But one thing is certain: the crypto market's next chapter won't be written by speculation alone. It'll be defined by resilience in the face of relentless economic and geopolitical pressure. Thanks for watching. If you found this video insightful, click like and subscribe for more.